All right, time for a big picture discussion. Joining me, Joe Mazzola is a head trading derivative strategist at Charles Schwab. Joe, we are trying to hold on to our gains today, but having some trouble doing so. Take me through the session the way you saw it.
Look, Oliver, we're basically 50 points off the futures high of the day in the S&P 500. So not a very strong close. Maybe we get a bounce. Maybe you and I could talk it up. I don't know, but it's interesting if you kind of look at the week. We've got mixed data. I mean, it's just that's the way it is. You've got some decent economic data. It was basically GDP and PCE. You had the jobs data today, which probably will be revised. So you have to look at that as negative right now. But then I think, everything was really contingent upon two things. It was the mega cap earnings and then the fixed income or the yield rally that we saw. And when I look at the mega cap earnings, maybe, 2 out of the 5 impressed the street. And when you look at the bond yields, you and your prior guests were talking about that right now. I mean, anytime they try to push them back down, they rip them right back up. And it hadn't, had a huge effect on equities yet, but I think it's starting to take its toll now.
As we see equities balance these things, of course, we got another one next week. What do you make of VIX, where it's at right now, Joe?
Yeah, no, so that's interesting. When you look at October as a whole, the net change, or the percentage change is a better way to put it, on the VIX was the third highest, basically going back to 1992. I'm looking at a Bloomberg data right now. Yeah, there was a third highest change that we'd seen in VIX from start to end. We closed out around 22.5, and we're basically back there. We're pretty darn close to it right now. So, there's some hedging that's back. We're seeing some skew come back into the market a little bit. It seemed like it took a break for a week and a half, and you're starting to see those buyers back in there today. One thing that I found really interesting, Oliver, and just kind of looking around for some trades from yesterday. If you look at the ETF for the clean energy ICLN, a lot of call activity yesterday, and primarily on the buy side. So I don't know. That's a bit of a risky trade going into the election, but there were some buyers.
Well, we saw also some of the prediction markets narrow back down closer to where the kind of break-even polls are suggesting. Those who are trying to make the policy-informed bets are going to have a pretty tough time doing so. But, I mean, 22 VIX that kind of popped with the earnings drop-off maybe keeps us at a kind of level of angst that lowers the bar for disappointment. You know what I mean? Like, if the idea is VIX is going to have air come out after the election, it's a lot easier to let out air at 23 than 20, and more than 20 at 15, et cetera.
No, it makes a lot of sense. I think the other thing to consider, Oliver, is just the level of expectations for the mega caps this week. I mean, everybody was saying not only do you need to beat, but you need to raise, and on top of that, you need to tell us what the heck you're doing with all that money that you're spending on AI. And really, there was only a couple of companies that were able to really kind of demonstrate that, and that was Google and Amazon, and everything else was, I don't want to say taken to the woodshed, but pulled back a little bit off the earnings. Microsoft taken to the woodshed to a certain extent, but that's kind of the activity that I saw. Now, looking at that, and I think this is important just because of the weights that they have in the market cap. Meta is basically kind of holding on to that 50-day moving average. It's right there. You can see Microsoft broke below all its major moving averages, and Apple broke below its 50s. So, from a technical standpoint, that's not very healthy, for those stocks in particular. But then when you look at the market as a whole, the S&P 500 is trading right around that 50-day moving average. If that goes because of the weight of the market cap of those stocks, there could be some further downside ahead.
Yeah, I like that point. As the giants cut and take, in both directions. So giveth and taketh. Now that we're through that, we get the second and third rounds of earnings, which will get into some more of the software stuff in a couple weeks, and kind of the meat. I will say the consumer group, it seems like, was pretty healthy. Airlines, travel, Amazon also, e-commerce. I mean, it seems like things that are pretty directly tied to consumer and employment. That was one of my other takeaways from this week, kind of big picture-wise, is that those seem pretty solid.
No, I would agree. And I think that the GDP data confirm that, personal income, personal spending, all looks pretty healthy. I think that we're just talking about a market that's trading off a pretty pricey multiple. And that has a lot to do with, where these stocks are priced now, and in order for us to kind of get back into a more normalized PE environment, either the E is going to have to jump or the P is going to have to come down. And yes, earnings are up with 75% beat rate, but expectations coming in, as we talked about before, they've been lowered. I think it was around 4.2% year-over-year growth expected for Q3. We're somewhere in the 6.5% to 7%. So that's a beat, but it's not like what we were seeing in the previous quarters where we were getting the double-digit growth rates. And when you're looking at a market that's priced for perfection, sometimes you'll see a slip up there.
Yeah, well said. We needed to see perfection, even though it was impressive, nominally impressive, big, huge numbers. For trillion-dollar market cap stocks, just maybe a slight less version of that trillion, because that's all we did. Took a little hair off the top, basically, a little haircut to the valuations. Thanks, Joe. Appreciate the thoughts. Good big picture themes.